Yes, business insurance, assurance, individual and group. Example, private health insurance, private medical insurance and death in service benefits. Reason to recompense the business for loss of profits due to the absence from work of a key person. Example, a limited company with, say, 3 directors will want to effect life assurance on each other for the benefit of the surviving shareholders. This is known as share purchase protection. Group life assurance. This is a death in service benefit. Employees covered to a level of benefit that is often expressed as a multiple of earnings stroke salary, often up to 4 times their salary. Possible calculation for a group scheme is the total sum assured for all employees multiplied by the single premium rate equals the total group premium, sometimes referred to as application of a unit rate or of simplified administration. Some policies contain a continuation option if an employer leaves or retires, permits him to take out a policy for the same sum assured as that under the group life. The employer will obtain tax relief on the contributions he makes to this group life scheme. No liability will arise on the employee on the premiums paid on his behalf because this comes under death in service pension legislation. Benefits are completely free of any taxation liability. There is no tax liability on the estate of the deceased because it's written under discretionary trust. Trustees do have the power to override a nomination or expression of wish if they feel there's a more deserving cause. Income replacement, permanent health insurance. The term actively at work refers to employees who are actively at work at the time any group PHI is put into force. 75% limits are put on these policies to give an incentive on the employee to return to work. Taxation. The employer does receive tax relief on his contributions. He is then taxed on any benefits paid to him by the insurance company, but against this potential tax liability, he can offset benefits then paid by him to the employee. Thus, if he pays to the employee all of the benefits the insurance company pays to the business, then no tax liability will arise on the employer on payment of benefit. As regards the employee, he is not taxed on the employer contributions to the scheme as a benefit in kind, as long as the scheme has received approval from the Inland Revenue. The employee is, however, taxed on the income he receives during a claim, as if it were earned income. Class 1 national insurance contributions are also payable for the same reason, both by employees and employer. You should note that if the scheme includes directors or partners of the employer, then these may not be tax relievable. Taxation of the group of individual contracts. Generally, premiums paid by the employer will be deemed to be benefits in kind in the hands of the employee and taxable as such. The employer would still obtain tax relief on his contributions as an allowable business expense. When benefits become payable, they are payable to the employee. As such, they will be paid free of tax liability for 1 calendar year, but then taxable in the same way as individual PHI policies. Private medical insurance. Taxation regarding medical insurance paid for by the employer. As with income replacement, the employer can offset his contributions against his taxable profit as a business expense, thereby gaining tax relief. The employee is liable to income tax on these contributions as a benefit in kind. Benefits paid will usually be the cost of paying for the medical treatment, and no tax liability exists on those payments. Summary of group benefit schemes. General rule for the tax treatment of premiums. Premiums paid by an employer for policies for the benefit of employees may generally be offset against the employer's taxable profits as a business expense, but are then taxed as a benefit in kind in the hands of the employee, who is deemed, therefore, to have received those premiums as if they had represented additional earnings. However, for DIS and approved group PHI, no such benefit in kind tax treatment will arise on the employee. There is no general rule for the tax treatment of benefits. Death in service benefits are tax-free. PHI benefits are taxable, but this depends on how the scheme has been set up. Medical insurance benefits are paid without tax liability. Insuring employees with benefits payable to the employer. The term key person policy is used to describe an ordinary life policy, usually term assurance or whole life. It's a prerequisite of key person insurance that the employer can demonstrate that he will be detrimentally financially affected by the death of that person, i.e. he's got an insurable interest. Note, key person PHI, it does exist as well. The company as employer owns the policy. 3 methods of calculating loss of profits from a key person. Multiple of the key person's earnings. 2. Multiple of the company's annual profits. And 3. A formula which attempts to define the proportion of the profits for which the key person is responsible. Factor 10 is used for multiple of salary. Factor 3 is used for multiple of annual profits. Best approach is the formula calculation, and the formula is the company's annual profits multiplied by the key person's salary divided by the company's total wage bill, and then this is then multiplied by the number of years profitability affected. Policies on key person insurance generally don't benefit from tax relief. However, Inland Revenue may allow tax relief if the following are complied with. The policy must be of short-term nature. The relationship between the proposer and the proposed life assured must be one of employer-employee. The policy must be effected to cover the anticipated loss of profits on the death of the key person. The key person must not have a substantial shareholding in the company, and the policy must not have an investment element. Short term is interpreted as a term up to 5 years, and this would be acceptable. Clearly this would rule out whole of life policies, as these would then not benefit from tax relief. Significant or substantial shareholding means a key person must have less than 20% of the voting shares. Investment content, this would also rule out endowment and whole of life policies, and then again only leaves term assurance. Therefore, what policies are only true key person policies? Only term assurance contracts with a term of less than 5 years could qualify for tax relief. Where the policy does qualify for tax relief available on premiums, then any death benefits payable from these policies will subsequently be liable to taxation in the hands of the company as a business trading receipt. However, where the conditions aren't met, then there will be no tax liability on the payment of benefits. Insuring the business proprietors with benefits payable to each other. Limited company. 50% partners would be advised to effect a life of another policy on each other, or own benefit policy, and then assigning it to the partner so that they can buy each other's shares if the other dies. To help overcome potential problems on a shareholder's death, 2 main types of agreement could be noted. 1, a buy/sell agreement. 2, a cross-option or double option agreement. Firstly, buy-sell agreements. Here the surviving shareholder is obliged to buy the shares from the deceased's beneficiaries, and that beneficiary is obliged to sell the shares to those survivors. However, the use of the cross-option scheme is much more popular due to the potential loss of inheritance tax exemptions which a deceased shareholder's estate could suffer. What is a cross-option agreement? This is where the beneficiary of the shares and the surviving shareholders can force the sale of the shares from the beneficiary to the survivors. There is no tax relief on the premiums if paid personally by the shareholders unless pension term assurance is affected. If the company pay the premiums, they may be able to claim the premiums as a business expense. Those premiums will be taxable on the individual shareholders as a benefit in kind. Automatic accrual. Where included in the partnership agreement, this clause means that on the death of one of the partners, his interest in the partnership automatically accrues, that is, passes to the surviving partners. and not to the deceased's estate or beneficiaries. With automatic accrual, life assurance needs to be effected to protect the interest of each partner's dependents. For the self-employed, there is no eligibility to statutory sick pay. Instead, benefit is called incapacity benefit. The 75% maximum benefit rule for PHI for self-employed people is based on an acceptable measure of lost profits. Benefits for PHI cease on the earliest of return to work, death, termination, or the date of anticipated retirement. PHI is designed to replace lost earnings. Note, with unit-linked PHI policies, there are no fixed premium unit-linked PHI policies. Benefit restrictions is almost invariably 75% of the individual's pre-disability earnings less any continuing salary paid by the employer, and also less any state and other benefits which are payable as a consequence of disability. Proportionate benefit is a feature of an insurance company's PHI policy conditions. Benefits will still be payable under the policy proportionate to the loss in income. This is where an individual is not entirely prevented from being able to work. Factors influencing PHI premium: age, sex, occupation, health and pastimes. Females will pay higher rates than males due to the morbidity risk. Typical exclusions where a claim will not be met are self-inflicted injury, failure to follow medical advice, act of war or rebellion, pregnancy or childbirth, injuries caused during criminal activity. There is no tax relief granted on the payment of individual PHI premiums, except possibly where those premiums are paid for by an employee by an employer. Individual PHI policies paid by the individual. Benefits are free of all liability to tax for the first 12 months only, but then will be taxable as unearned income. Sickness and accident insurance. Sickness benefit typically has a shorter deferred period than PHI policies, usually 7 days instead of 4 weeks. Sickness and accident are usually restricted to being paid for only 1 or 2 years. PHI policies cannot be cancelled by the insurer. By contrast, sickness and accident may be cancelled by the insurer. In addition to regular benefit, most sickness and accident policies pay a cash lump sum benefit. There is no tax relief available on sickness and accident policies. Benefits, however, are payable tax-free for the first 12 months of illness, in common with PHI benefit. Thereafter it's taxed. Lump sum benefits are not liable to taxation. Critical illness. There are variations in the definitions of critical illness. Permanent and total disablement will usually cease at a specified age, usually age 60 or 65. This is because it's designed to cover loss of earnings. Underwriting considerations are age, occupation, sex, health, pastimes. No tax relief is granted on premiums, and there is no tax liability on benefits. Private medical insurance. These policies pay for private medical treatment for the insured, both inpatient and outpatient, by a simple reimbursement of the cost of that treatment. Policies affected on annual and renewable basis. Minimum age is typically 18 for private medical insurance. There is no tax relief allowable on premiums to these policies, except where those policies cover individuals aged 60 or over, in which case tax relief at the basic rate of tax is allowed. It's worth noting the tax relief is allowable on whoever pays the premium, so a son or daughter could affect this policy. No tax liability on benefits. Long-term care, paid by either a single lump sum or regular premium, pays benefits where a person is unable to carry out a stipulated number of activities like feeding, washing and bathing, using the toilet, walking, dressing. There is no tax relief available on these contributions. The fund into which contributions are paid is taxable as a life fund. If benefits are bought by a single lump sum, then the policy may be based on an annuity, with tax treatment of the benefits being that of the taxation of a purchased life annuity, i.e. the capital content is free of tax and part taxable. Benefits are usually payable free of liability to tax. The following is true of 10. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. Maximum total investment £9,000. Maximum first year investment is £3,000.
Interest is free of tax if it is held for the full term.